Welcome to Beat the Bank, the podcast that unpacks how Kiwis actually build wealth. Because for most people, leaving money sitting in the bank isn't enough anymore. If you want to grow real wealth, you need to understand how to make your money work harder through investing, business, and smarter financial decisions. Each fortnight, we sit down with investors, founders, and financial experts to unpack the strategies, lessons, and opportunities behind building real wealth. Proudly brought to you by Venture, helping Kiwis build long-term wealth. Quick disclaimer, this is for general information only, not financial advice. Please speak to a qualified advisor before making any investment decisions. Today's guest is Matt Goodson, founder and portfolio manager at Salt Funds, who has delivered close to 17% per annum over the last 3 years. Matt has spent decades in markets as a professional investor, known for his ability to identify opportunities others often overlook, including strategies that perform in both rising and falling markets. Through Salt, he manages a range of investment funds, including long-short strategies that aim to generate returns regardless of market direction. Today, we're unpacking how investors can actually make money in volatile markets and what most people don't understand about how markets really work. Enjoy the conversation. Thanks, Matt, for coming on the podcast today.
Pleasure.
Most people think you make money when markets go up, but some people actually make money when markets go down. It'd be great if you could just unpack that a little bit.
We've run a long-short fund for over 12 years now. The aim of that is your longs, which are companies that you own, like anyone would in a normal fund. Hopefully they go up when the market goes up. But conversely, your shorts, where you borrow stock that you don't own, you sell it, and you hope to make money by buying it back at a lower price, and you can make money then when the market goes down. So the trick is to try to make money both times, both when the market's rising and when it's falling. So what I would say to people is, on average, markets do rise over time. Companies pay dividends, companies retain some profits and reinvest, and on average, that leads to rising share prices, obviously, with wide variance across companies. But there are plenty of times where companies get overpriced, or where companies run into competition, or they simply structurally end up in a very poor position. You wouldn't want to own a blacksmith shop in the 2020s. You can make money in both types of different market conditions, but you do, I think, need to be conscious that in general, markets do rise. So the way we've put together our long-short fund is, in the average returns we've had over time, we've made about 6 basis points, so that's about 0.06% on average when markets have fallen. And we've made about 2 basis points, about plus 0.02% on average every day over thousands of days when markets have risen. So it is actually possible with a careful mix of longs and shorts to make money in both conditions.
Right.
But from time to time, you'll see people who are really, really long. Markets go up and they look like superstars. Occasionally, when you've had market crashes, people who only short sell look like superstars, but generally they've now gone out of business. So what you need, I think, is a very careful, balanced approach to the two.
Okay, nice. And I guess just taking it back a little bit to what a short actually is. I know you said you borrow the stock. So how does that actually work in practice?
Yeah, let's think of an example. There's 2 sort of broad categories of companies we like to short sell. One of the stocks that are structurally impaired, but no one's quite figured that out yet. Markets are pretty efficient, so it's not always easy to spot those in advance of everybody else, but we try to from time to time. And the other category, which tend to be far more easier to find, what I'd call overpriced glamour stocks, where stocks have done well for a period, they get up to extremely overpriced conditions on the assumption that they'll keep doing well forever afterwards, but you can find a catalyst to expect that might not continue to be the case. So a classic example that's in the portfolio at the moment is a company called Reece Corporation. They are one of the largest plumbing retailer across Australia and New Zealand, and they're also expanding in the US. They've done really well in recent decades, and they became a glamour growth stock, a plumbing retailer trading at 40 times earnings. Yet every time they reported, they beat expectations. Everyone loved them. Every sell side at broking analyst had a strong buy on them and ignored the valuation. What we could see coming down the pipe was in the US, 30-year bond yields, which is what their mortgage rates are set off, were rising quite quickly. And in Australia, the economy was overheating. And you could see that it was as good as it was going to get, and the RBA was going to have to raise rates. Now, what's that going to do for plumbing product demand? What does that do for the buying and selling of houses, which really drives that sort of demand? And so, lo and behold, about a year ago, they had their first shock downgrade, and they've had several more since. So, still a great business over the long term. But because of the downgrades, it's still actually on about 30 times forward earnings. Whereas to us, that sort of business should be much more be on a 15 sort of PE type multiple.
Yeah.
So that's the sort of thing we look for. How do we, in practice, do that? So what we do is we reach out to what's called a stock borrow desk at one of the major investment banks, and I'll say I want to borrow 20,000 Reece shares. So they will borrow those shares off someone who owns them, which is typically be a global index fund or a global pension fund or somewhere. And they will pay a very small fee to borrow those shares, and they'll charge me a slightly higher fee and make money on that gap. So then I, for a very brief period of time, am in possession of those shares that I've borrowed, and I then sell them in the market. So my aim is to sell them at $30 and buy them back at $15.
Yeah.
And I make the difference. When I say I mean the fund, obviously. Which I'm invested in. But, yeah. So that's the way it works. And in a portfolio sense, what I'm looking to do is have 40 or 50 companies that we really like or we think are really good trading opportunities. And I'll balance that off by having 30 or 40 companies typically that I've short sold.
So you've borrowed the stock at $30. So then the stock falls from $30 to $15. And then what happens then?
I'll buy them. I hand back for 20,000 shares.
How do you buy them?
I go in the market and buy them because I have a position where I've sold short 20,000 shares.
Right.
So I might hold that for a few months or a few weeks or whatever the period is. Share price falls, and I then go and buy those 20,000 shares back. And then I hand them back to the people I've borrowed off.
Right. So
and everyone's happy.
So they don't miss out anything because they just get their shares back.
Exactly.
And you're winning how? By
selling at 30.
Right.
And buying them back at 15.
Right.
So I've just made $15 a share on 20,000 shares, which is $300,000.
Okay.
Minus a very small borrow costs.
And you'll only do that on shares that you find are either structurally impaired or overpriced glamour stocks.
Overpriced glamour stocks, or maybe a company that's not super liquid's going into a big global index, and we sort of twig to that fairly early. That's one of the things we watch for, so it gets hopelessly overpriced on fundamentals. And there's an opportunity there to establish a position. Or sometimes we'll just short sell a company to manage risk.
Right.
We might think, gee, we're actually really long now. What say Donald Trump loses his mind and bombs Iran tomorrow? Gee, we'd better short sell a couple of things just to manage the risk in the portfolio.
Yeah, exactly. Yeah, so what would that look like in practice? What would you be, are you thinking about that at the moment?
Absolutely. And just, it's a bit of an aside really at the moment, but we've got $1 each way on the outcomes there.
Yeah.
You don't know how that's going to play out, whether it's going to be a drawn-out quagmire with oil cut off for many months, or whether we find a solution in the near term. If we find the evidence to have a strong macro view like that, we'll put it in place. But at the moment, it's just too hard to tell on what's our edge.
Yeah.
We don't have one. Unless you're Barron Trump, you don't have an edge in that situation.
Yeah. And I suppose you're investing in Australasia, right?
Exactly.
Across New Zealand and Australia. So like the indirect repercussions of what happens in the Iran war is probably less predictable than if you were maybe investing in US or
possibly
emerging market
I mean,
stocks.
these days the information, there's so much information. I don't think the edge is having the information; it's analysing it.
Yeah, right.
So there's certainly plenty available, but
okay.
Yeah.
One of the first kind of finance movies I ever saw was The Big Short. Have you seen that?
Yes.
So I thought it'd be interesting to kind of unpack that a little bit as well as best we can around, because that was around the GFC time with Michael Burry. So yeah, for the audience, it'd be great if you could just, in your own words, what he did and how did he make money on that?
There's a bit of complexity there, but let's say there's $1 million mortgage. Normally when a bank writes a mortgage, the bank will retain that mortgage and collect the interest payments and gradually make money over time from the costs to the bank to fund that mortgage and what they charge on the mortgage. And grinds away slowly for many years until eventually the mortgage is all repaid. Wall Street being Wall Street though, that was all a bit slow, so they securitised that mortgage. So what would happen there is you'd set it up into tranches. So you'd say the lowest risk tranche, let's call it $500,000. That's the first $500,000 to be repaid. So it's the lowest risk. And then they'd tranche out the other $500,000 of that mortgage, and each of those tranches would have a preference in terms of being repaid. So when house prices started falling in the US, the highest risk tranches of those mortgages were suddenly in trouble because, crikey, the house that they've lent on isn't worth that anymore. And by the way, the person probably doesn't have a job to repay the mortgage. So all of a sudden, instead of being a $100,000 tranche with a 15% interest rate to reflect the risk, suddenly it's worth zero. Now, Wall Street being Wall Street, then rather than just separating those tranches out, made big portfolios of them. So what they'd do is say, okay, one mortgage for highest risk tranche, that's obviously pretty risky. So what we'll do is we'll bring a couple of million of those mortgages together and we'll assume that the risk on them isn't correlated. That when one mortgage goes bad, it doesn't mean another mortgage is going to go bad. Mm-hmm. And we'll pay a big fee to Standard & Poor's or Moody's, and they'll tell us that, bingo, we've just transformed the riskiest part of this mortgage, where if anything goes wrong with the house price or someone's job, all of a sudden it's low risk because there's a whole lot of those mortgages in that tranche. Mm. And so, of course, what Michael Burry spotted was that all of a sudden the payments on these mortgages were falling behind, yet Wall Street was sitting there in these funds with heaps of high-risk mortgages in them and valuing them as though they were perfectly riskless. Mm. And they kept making these false prices. If you remember The Big Short, he was in there screaming at Goldman Sachs about how they were pricing it and why weren't they repricing it, and he was lying awake on the floor in his office at night. Yeah. And then eventually they repriced in one heck of a hurry. Yeah, yeah. So that was what happened. It was financial innovation, very stale and sort of pricing that was like groping through a fog, and a mistaken belief that the risks in those tranches of mortgages weren't correlated when they very clearly were.
Right. So it's almost like, if we think about a New Zealand example, 10 people around the country, you've got 3 with no jobs but somehow got mortgages, and then you've got another 3 who are doing okay, and then another 3 that are good. And someone's just lumped all their mortgages together and then created this tranche per se, and then sold that to someone else as a investable product.
Yeah, and as though all of the mortgages are good.
Yeah, as if all they're good.
And it's priced as though all the mortgages are good.
Right, and then when the interest rates went up, the 3 people who didn't even have a job, they weren't really paying anyway, but they couldn't continue to pay, and that raised the risk rating of the whole thing. Yeah. And then it all just fell like dominoes.
Yeah. Some of the mortgage people get repaid first and some get repaid last. And clearly the ones who get repaid last, their investment's valueless. Yeah, right. But Wall Street, and Burry had spotted this, but Wall Street was still pricing them as though they were going to get repaid in full. Right. That was his unique insight.
And so he basically did something similar to what you do, where he was selling something for 100 and then buying it back at 50.
At 1.
At 1, okay.
There were massive gains made from people who spotted that trade.
Yeah.
They made billions of dollars.
But there wasn't even a market for it, was there? He had to create the market.
It was an over-the-counter market, which is why he was screaming at the brokers, is why are you still pricing it like this?
And so I guess when we think about broadly with shorting, is there a particular, I know you talked about before that you've got the things that you look for when you're looking to short stocks, which is structurally impaired and overpriced glamour stocks, but there must be a kind of a macro overview, right? Because if everything's going well, interest rates are low and, the economy's doing well and there's lots of earnings growth, there must be less opportunities to short stuff, right?
Typically there's more.
Really? Wow.
Because when those conditions last for a while, human nature being human nature assumes that they'll continue on and starts putting a bigger and bigger multiple on the current earnings of the companies. And those conditions never last forever. Something always comes along, as we've seen. In my investing career, you've had the 87 crash, you've had the NASDAQ meltdown, you've had Fukushima events, you've had September 11, you've had the GFC, you've had Trump trying to bomb Iran back to the Stone Age. Something always comes along.
Yeah.
So those wonderful periods of peace and everyone making lots of money and being happy actually create the conditions. The hard part is timing those correctly and figuring out what is the catalyst here.
Yeah.
And then not being too early. And that's one of the biggest things we have to be very careful about and can struggle with from time to time. It's not so hard being ultimately correct, but if you're correct too early, you can look as though you're losing a lot of money for a while. And that's one of the hardest things is getting with a short, you both have to be correct and get the timing right.
Right, yeah. So I guess really, then that kind of strategy can work in, pretty much all markets then, because then it also works when markets are falling as well, right?
Well, you put it on when markets are booming and you make the money when the market starts falling.
Right, yeah.
But, if we think back to the wonderful run that the S&P in the US has had in recent years, a number of prominent perma-bear hedge funds have had to close up shop. They just haven't been able to make any money. So, and we're always conscious that markets, on average, do rise because they pay dividends which give people a return and they reinvest their profits. So over the long term, markets do go up.
Yeah.
So, short selling is not a road, it's not a road paved with gold. It's a way of controlling risk and being able to make money with 30% of the time when markets aren't going up.
I think that's a really good point you make, actually, to answer that question, is you put the short on when the markets are going up and you make the money when it's going down. And actually that's the same thing when you're only investing long, right? As you should be putting money in when the markets are down and making the money when markets go up.
Indeed. And and the hardest thing, though, is it's obviously, Harry Hindsight's a wonderful investor.
Yeah, he's the mess. He's the man.
Never gets it wrong.
Nah.
But, I think for the average investor, it's very, very hard to do that. You're busy with your life, you're looking at other things. So, when people ask me for advice, which I'm not a financial advisor, so I can't, I'm merely a fund manager.
Yeah.
But I think the simplest piece of advice is to dollar cost average. And that means you put $1,000 in on a regular basis. When the price is high, you get fewer units. When the price is low, you get more units. Because human nature is when prices are low, you feel scared. There's something out there that's ugly and scary and prices are falling, and it actually takes some real guts to invest in that time. But if you have a disciplined dollar cost averaging approach, I think that is the best. That is the best way to go about it. And so you're actually getting, more units when you're buying at the height of COVID fears or at the height of GFC fears or what have you.
Yeah.
And you're actually buying fewer units when everything feels wonderful and easy and the market's at its highs.
Yeah. I guess that works. That wouldn't really work if you've got a larger lump sum, though, right? If you've got like $500,000 and you need to deploy it, I guess it's a little more difficult, and I guess that's where a kind of a diversified portfolio comes in handy a little bit, right?
Absolutely. And that's where I think, financial advisors, play an absolutely essential role. Because, when you have that large lump sum, it totally depends on your own personal circumstances and your own risk tolerance. And you need someone who can assess that and, help you through that, and importantly, hold your hand so that you don't feel that fear when markets are falling, and you don't feel that euphoria to chase risk when markets are rising. So, it's just getting a good settled asset allocation that accurately reflects, your risk tolerance and your return needs.
So I guess if we think about a diversified portfolio and we're thinking about maybe a long short having a role in that diversified portfolio, why do you think most investors kind of avoid those types of strategies?
Yeah, I don't know if it's so much active avoidance, it's just they aren't really that available, particularly in the New Zealand market. Our long short fund is one of a few New Zealand, or just about the only New Zealand domiciled market neutral long short fund. And so what I mean by market neutral is if the market's up 20%, we want to be up 12%. If the market's down 20%, we want to be up 12%. If the market's flat, we want to be up 12%. It's very different to a long only fund where if the market's up 20, we want to be up 25. If the market's down 20, we're doing high fives if we're down 15.
Yep.
It's a very different way of investing. So I'd put it very firmly in the alternatives bucket. So the aim is to make money at a time when other strategies may not be making money. So it should only ever be a modest part of someone's asset allocation, but it performs quite a valuable role if it's not correlated. If you're in a situation where other markets are down, and you've got an asset there that's still grinding out positive returns, that does really good things to the risk-return trade-off in your overall diversified portfolio.
Right.
So it's very much in that bucket.
Do you think that most investors are too passive these days?
There's a couple of different elements there. One is there's been a growth in passive investing, which means just owning the index. And there's certainly some advantages to that. It tends to be low cost. But there's also some disadvantages because when a stock becomes larger and when its valuation multiple gets bigger, it becomes larger in the index. And so the passive fund naturally has to buy more of it when more money comes in. So it tends to have a bias to very large companies and to more expensive companies. And the growth of passive, I think, has created quite an opportunity for active managers in terms of greater volatility in companies as they fall into and out of indices, or companies that aren't even in indices. So that's one aspect of, are investors too passive? The second aspect is, are they too passive in terms of investing their money in the market, getting scared, pulling it out of a market, or just sitting there doing nothing? I'd actually argue that a lot of investors are almost too active. What you have to do is work with your financial advisor, get comfortable with the assets that you're allocated into, and hold the course.
Yeah.
And don't feel great when markets are rising and throw more money into high risk things. And don't panic when markets are falling and pull your money out.
Yeah.
What you have to do is, and the most critical thing, is getting the right asset allocation for your risks and returns.
Yeah.
And I'll tell you a classic story here. There was from the late 70s through to the early 90s, there was a guy called Peter Lynch, which a number of people may have heard of. He was effectively the guy who made Fidelity. Fidelity's a Boston headquartered $1 trillion fund manager now, one of the largest, most successful fund managers in the world. Peter Lynch was sort of a Warren Buffett of his day. He did 29% a year compound at a time when the market was barely up. And Fidelity years later did a study looking at what the average investor in his funds made, expecting them to have maybe not made as much. What they found is most investors lost money. Now, how the heck can you lose money when someone does 29% a year compound for a dozen years? What would happen is they'd have a 50% up year. Everyone would think, crikey, he's doing brilliantly, we better give him lots of money. Then he'd have a 15% down quarter. It's, oh my God, he's lost it. markets change, they'd run. They'd take their money out and go.
Oh, no.
Then it'd be up 30 or 40%. Oh, it's safe to give them some money again.
Yep.
And that's why I say I believe a lot of people are too active. What you have to do is identify the good managers in advance, identify an asset allocation that you're happy with, and stick to it and be disciplined. And clearly, if you're not a professional investor, those aren't easy things to do. And that's where you work with a financial advisor, whose job it is to do that.
That's really good points, actually, because sometimes in my experience, I've seen people who make all sorts of investment decisions, right? Whether that be, private businesses or, they buy other, types of shares and stuff like that. But because it's not all managed in the one place, like they don't actually have an understanding of what the
overall portfolio looks like.
Exactly.
Exactly. And that's, again, I think where a financial advisor is important. You may only have a portion of your wealth with that person, but they can take an overall view.
So Matt, to help people build real wealth and beat the bank, in your own philosophy, how do you think people should achieve that?
Look for a couple of things as the core of investing. Companies that tend to go up over time tend to have an ability to reinvest and earn a return well above their cost of capital. So what I mean by that, for example, Turners is a name we've owned for 10, 12 years now. Every time they open a car yard, that car yard's turned profitable in 1 to 3 months.
Wow.
And they'll be making a return on the funds I've invested in that car yard of 30 to 50% plus. So what they can do is they generate a lot of free cash flow from their business, use some of that to pay a dividend, and then can reinvest the balance of that and earn a really strong return. So what we've found over time is the best companies can reinvest and earn a really, really strong return as they keep reinvesting that money until one day through competition or through market size, all of a sudden they start investing and find that actually they're destroying value. They're either earning a return below what it costs them to borrow or below what their equity investors expect, or they're even making a loss on their expansion. And you can see, if you look back over the last 15, 20 years, that a company like The Warehouse has gone through that. So that's one thing I look for as a personal philosophy. The second thing I've looked for as a personal philosophy is separately I run a dividend shares fund, which aims to invest in companies that pay a high but sustainable dividend yield. Not so much sustainable in the ESG sense, but sustainable in terms of sustainable relative to the cash flows that the company generates after it's paid for all its capex needs. And as I'm getting slightly older, you tend to want to get more of a yield out of your investments. You start to naturally shift from just wanting growth and looking to build the kitty to actually wanting to get more of a yield. So I've probably started to change my own personal investment philosophy slightly towards some of those more sustainable income generating type stocks.
Yeah.
So I do invest personally and do have a lot of my investments naturally tied up in our funds. But that's sort of the things we look for at Salter, companies that can genuinely reinvest and grow value. And sometimes that company might be on a trade at 30 times earnings, sometimes it might trade at 5 times earnings.
Yeah.
It just depends. Or companies that can pay a really good sustainable yield that's certainly well above what our friendly banks pay us.
Yeah.
And at the moment in New Zealand, it's actually not that hard to generate a yield well above what the banks are paying in companies that are perfectly reasonably valued. So it's our market's been a bit of a grind in recent years, and the economy hasn't been in a great place.
Yep.
But because of that, I think it's the first time in a few years that I actually feel reasonably optimistic on the outlook, and it's not hard to find decent companies at reasonable valuations.
All right, beautiful. Thank you very much, Matt. It's been great having you on, and good to hear about how you've been in the bank.
Yeah, pleasure.